Hello, my trading friends, and welcome back to Forex Focus, brought to you by IG. Taking a look at the current projections for where the Fed will be headed for interest rates in 2024, as they've changed drastically in the recent weeks since the first FOMC of the year. We'll map that out for you, as well as where US dollar could be headed in these different scenarios. But first, let's start with that US dollar price action, because you may have seen huge strengthening in this dollar, not only to start the year, but especially after the January FOMC that just occurred and the non-farm payrolls here in February, back-to-back huge events. And as the dust has settled and the smoke is cleared here, so to speak, we're seeing a strong dollar across the board. And here in that euro-dollar pair, that means weakening for the euro, getting back down close to 107. And you'll remember that recent lows for the last year or so of trading here in this euro-dollar market are approximately 105. So not very far from lows in euro, highs in dollar. And that's pretty much the case, like I say, across the board, very close to highs for USD against the yen, against the pound, against the Australian dollar as well. Some huge volatility entering that market as well. And like I say, this is on the back of a complete shift in interest rate projections for the US. And you may have seen that the projection for the March meeting has gone from, a month ago being greater than 50% chance of a cut, the first cut from the Fed since the pandemic, coming at the March meeting, to around 50-50 about a week or so ago, to now less than 15% chance of that first rate cut coming in March, and these odds slipping even further after the recent interview on 60 Minutes with Fed Chair Powell, saying that the danger of moving too soon is that the job's not quite done yet. And so, again, tipping his hand to, we're not really ready to move lower in interest rates, especially given the outperformance the U.S. is seeing on employment numbers, inflation numbers, GDP numbers, on so many data points. But let's stick with the interest rate story here and dive a little bit deeper into the long run plan here, because this is all to say, yeah, maybe we're pushing out some of these rate cuts further in time, but the expectation from Powell so far here in 2024 is that they're still expected to cut. And you'll remember that the most recent dot plot from the Fed, the different central bankers projecting maybe 2 or 3 25 basis point cuts. And just as a side note, the Fed has historically moved in 25 basis point increments, and so I'm going to just assume that every time that they cut or hike, it's in that 25 basis point increment, and that'll come into play in just a second, because you're looking at here the end of the year projections for where interest rates will be. So not looking like they're going to be lower by the March meeting, but by the end of the year, looking at about 100 to 125 basis points lower. So a little over a percentage point is the most likely outcome right now by the end of the year. And so that means going from around 5.25% where they are now, closer to 4% even by the end of the year. Now, where's this first hike going to come in if it's not going to be March? And that being said, March 20th is still very far away. It could shift right back if we see, inflation down at 2% in one of the next readings here in February or March, or we see an employment number that underperforms in March. That first week of March, you'll see the next employment data come out, then they could look at that cut for March, but obviously under 15% chance as of right now. May would be the next FOMC meeting, and they are seeing a greater than 50% chance of that 25 basis point cut in May here. But even this has been slipping a little bit, and you'll remember that the March cut odds were 70, as high as over 80% at certain points in recent months. And so this could slip away, or it could be that first cut here in May. And why is this so important to the long run of interest rate cuts? Well, like I said, they usually cut or hike in 25 basis point increments unless there's some crazy circumstances like the pandemic where something comes out of nowhere and they cut by 100 basis points or 75 basis points, more or less but more than that 25 basis point increment. But anyways, if we are assuming that 25 basis point increment and they don't cut in March, they only have 6 meetings throughout the rest of the year. And so that means that they would have to cut at 4 or 5 out of those 6 meetings to fulfill that 100 to 125 basis points worth of cuts. In other words, that would be a very aggressive plan for them to get to where the market is projected they're supposed to get to by the end of the year. And so this May meeting will be really essential to watch as we get closer to the March meeting and then on to the May one. If they don't cut in either of them, then interest rates might just be higher for longer as they're running out of meetings to cut at. But right now, the projections showing greater than 50% that the first cut would come in May and about 1 to 1.25% of cuts throughout this year. Now let's take a look at where people are situated in this euro-dollar market. A lot of people selling dollars as it's strengthening, maybe playing that mean reversion play, trying to catch the euro near its lows around 107 year-to-date lows, pretty much across major pairs in general versus the dollar here. But 70% of euro-dollar traders are currently long that euro, short that dollar, and that's the client sentiment that includes IG clients with positions in the market currently. So 7 out of 10 traders here at IG with positions in eurodollar currently long, shorting that USD into its strength. We'll see where interest rates end up. Obviously, there will be even more shifts to the projections in coming weeks leading up to that March FOMC. We'll see if they do cut or not. Obviously, looking unlikely at the moment, and that's been coinciding with all this US dollar strength.